Christiana. I am a professor in tax law at Queen Mary University of London. We're very happy to organize this online seminar today on Pillar 2, digital services taxes, and the US tax countermeasures. Today's speakers are, we were supposed to have 4 speakers. Unfortunately, Professor Ioannou has sent his apologies. He's unwell and he promised to join us in another event soon. We have Christos Theophilou with us today. He's a member of our executive education team. He's also a tax partner at the Taxand network of firms, a chartered accountant, a lawyer with an MSc from the University of Oxford. He's quite well known in executive education circles. He teaches international tax law for various other providers. Welcome, Christos. We also have Demis Ioannou. Demis is also a chartered accountant and a lawyer with an MSc from the University of Oxford. He is a partner in the World Tax Lawyers and a member of our executive education team. And our distinguished speaker today, who will be presenting his paper, his and Ruben's paper, is Professor Blažej Kužniavský. Hope I pronounced it well. He is a professor at the University of Lazarski, and he's a very distinguished scholar. He's published extensively. His doctorate actually won the 2023 IFA Michel Carroll competition, which those of you in the academic practitioner circles know is like one of the most prestigious awards. And he has written a lot in this area, especially on Pillar 2. I've read some of his work, very interesting work. And we're very thankful that he's going to present his paper. And following the discussion, the initial discussion, he will also to respond to some of the issues raised, and also presenting Professor Ioannou. Without further ado, I will start with Christos. I will let you start the presentation.
Hi, Christiana. Thanks for the very welcome introduction, and a pleasure to be here today discussing about an exciting topic, which is Pillar 2. Good afternoon, everybody. My name is Christos Theophilou. Today, what we're going to be discussing is, I will say, a topical issue about Pillar 2 and whether the new tax legislation, the new charge of tax, which is the very well-known UTPR that is being highly discussed lately, whether it is discriminatory or whether it's extraterritorial. I will be discussing whether the extraterritorial UTPR is against tax treaties, and then my colleague Demis will follow up for the discriminatory part. So let me begin with by saying that it is very, very important to consider whether the UTPR is effectively taxes covered. So if the answer is effectively yes, so we say that Article 2 UTPR is taxes covered, then of course we need to consider whether it is extraterritorial and whether it is discriminatory. But in case that the UTPR is not considered taxes covered, so the answer is no, and we're going to see more discussion on this part. Then, as we already know, Article 24, non-discrimination, because it applies for taxes of every kind and description, this means that it can still be considered non-discriminatory under the tax treaties. So here are all the options. And of course, another thing that we're going to see also in practice, in the absence of the treaty, whether the UTPR is also part of customary international law. Let me begin with step by step, and let me start by consider whether the UTPR is effectively taxes covered. Excellent question. We need to go to Article 2 of the OECD model. And the first thing that we need to consider is whether this the top-up tax is considered taxes on income. This is a direct tax. Is it taxes on income? Pretty much the first answer will be yes, because we are taxing income. Of course, we are going to see that we have different views, we have opposing views. But I will say that the quite majority we are discussing between us, this is taxing of income. We all know that the taxes of income is effectively defined and is broadly defined under Article 2.2 of the tax treaties. And there we also can also look at in the commentary, which is the opposite view, saying that we have a broad definition of what is taxes covered, but mostly this is there in order to cover taxes on federal, states, and any other taxes that they might have in subordinate municipality taxes and so forth. The first, if these two fail, if these arguments two fail, then we go to the third argument, whether this is a listed tax. I will say that I'm not aware of any treaty that includes a UTPR in the listed taxes, so most probably this argument will fail. And the final article, section, paragraph that we need to look at is on Article 2.4, which effectively Article 2.4 applies to taxes that they are identical or substantially similar to taxes on income. And maybe here the UTPR, which is a tax that is effectively applied after the treaty, if it fails to meet the definition of taxes on income, it will normally be considered as taxes covered under Article 2.4. Now, we all might consider that it is taxes covered. However, Professor Stephen Shea and Alison Christians, they argue in an article in Tax Notes International. I have the article here if you want to read more about this. They are also arguing that effectively the UTPR is not taxes covered because this is an excise tax and not an actual tax on income. And effectively they are raising two arguments on this end. The first one argument that they are raising is that the UTPR amount is effectively unconnected to the income that the company is paying. So assume, for example, that you have an affiliate entity in Italy and there is another affiliate in another country in Germany, or maybe not Germany because the UTPR within the EU doesn't apply, but let's assume that is in Egypt, for example. The tax that you are actually paying in your Italian affiliate is effectively something that is a top-up tax of another country and is not connected to the income of the taxpayer in that country. And of course, other than this, the second argument in this line of defense is the income allocated or attributed to that entity is effectively based on an income allocation formula, which is actually something that it was kind of rejected by the transfer pricing guidelines. We know that the formula apportionment is not the preferred method for allocating income under transfer pricing. And of course, the third argument in this line of defense is that any existing income tax liability is for another entity, and why I am paying taxes for the top-up tax that is effectively a tax for another country. So effectively, the Italian subsidiary is paying for a top-up tax, is paying for a tax for the reduced amount of a low tax entity, for example, situated in Egypt. And of course, the second argument of line of defense that this is effectively an excise tax is that the mechanism for reducing or using in order to effectively calculate this amount, which is a deduction to increase the cash tax expense, is effectively in substance no different than an additional tax or a surtax or any other separate levy. So for all these reasons, Professor Shea and Professor Christians, they conclude that this is no taxes covered, and effectively someone can argue that this is outside the scope of tax treaties. Now, if it's in scope of tax treaties, then we need to look at whether the UTPR is extraterritorial. And here I have two practical examples in order to look at. The first practical example is resident-based example. So effectively, what we have here is that we have a subsidiary, that this subsidiary in state C, they apply the UTPR, and your parent entity effectively has a top-up tax of 100. And the argument here is that Article 9.1, the transfer pricing article, might restrict the source state, which is state C here, for paying taxes on this end, because at the end of the day, what you are allowed to adjust under Article 9.1 is your arm length amount and nothing more than your arm length amount. At the same time, you might argue that the UTPR is extraterritorial because it effectively might be protected by Article 10.5 of the OECD model. We all know that this is the extraterritorial article for dividends. So we can also seek protection based on these two articles. And on the other side, if the group, the M&A group, effectively chooses to do business in state C with a PE there, so assume that here the operating company is a PE. This means that the line of defense is different, and here you can argue that based on Article 7.2 and of course 7.1 of the treaty, the profits that are attributable to the permanent establishment are the profits that are based on the OECD authorized approach, or if it's before the treaty is before the 2010 update, based on the pre-AWA method. And what does the AWA or the pre-AWA method is that these profits should effectively follow the OECD transfer pricing guidelines if it is the AWA. If it's not the AWA, then you have the old way of calculating the profits. So anything above those profits should not be taxed in the state where the P here is located. Now, based on these examples, we know that the OECD position for many years, it was that CFC rules, which is a perfect example of extraterritorial, says that the CFC rules around the globe are something that is legitimate and something that countries are following. Of course, there have been raised concerns about many countries that whether the CFC rules might conflict with tax treaties based on Article 7.1 and Article 10.5. And for this reason, we all know that in the BEPS project, the OECD introduced Article 1.3 that is effectively coming from the US model, that it says that the resident state is not restricted for taxing its own residents. And in this end, Article 1.3 says that the CFC rules cannot be restricted by tax treaties. However, the commentary of Article 1.3, it says that even in the absence of this article in tax treaties, and we all know that this article has not received much attention in the MLI. Not a lot of countries effectively included 1.3 in their MLI, but still what the OECD says that based on these paragraphs here, paragraph 14 of Article 7 and paragraph 37 of Article 10, it says that effectively this is what it was intended for CFC rules, and effectively even if you don't have in your treaty the specific article, still CFC rules apply. And let me also mention that the UN model also says that the CFC rules are applied. So we see that the OECD and the UN model are following hand in hand the same approach and the same methodology. Now, what is the current position of the OECD? If we see the blueprint of Pillar 2, it follows this paradigm. So the blueprint that was published by the OECD before the GLOBE model rules, it says that the UTPR effectively does not infringe the profit attribution rule based on Article 9.1 and 7.2. And the main reason is that what is the argument of the OECD is that once the profits have been allocated in accordance with the arm's length principle, how they are taxed is a matter of domestic law and not part of the treaty. So therefore, that's why the OECD decided that the UTPR and the IIR is not required to be included in any multilateral instrument, but rather is changes to the domestic law. Now, but let's get into the practice. We all know that, Christos, what you are saying is very nice, but what happens in practice? what if I have a treaty? What if I go to our domestic courts? What will happen? So the key here is that we have seen that treaties have been overwritten by many states. So if you have, for example, a practical case and you go to court, and if your state is a dual state, this means that the answer here is yes. We know that treaties override, in certain cases, the domestic law. So you have dualist systems like the UK, the US, and Germany, that they can actually override the domestic law. But in a different case, if you are not a dualist state and you are a monostate, and we have here countries like Belgium, Cyprus, France, the Netherlands, and Switzerland. If you are a monostate, it means that the treaty cannot override, sorry, the domestic law cannot override the treaty because the treaty prevails over domestic law, and usually this happens via your constitution. So in this case, it will be very difficult to override the tax treaty, the domestic law. So if you are a non-EU member state and you are a monostate, effectively in practice, you might end up in a situation that you might not be able to you will be able to seek treaty protection, and the domestic law cannot override the treaty. However, if you are part of the EU, like Cyprus, for example, or France, and we all know that part of the EU law has supremacy over tax treaties and domestic law, then the EU law will prevail, the EU directive will prevail, and you are going to follow the EU directive. However, there is a specific article within the EU that effectively says that it respects the treaty with EU and third countries, and therefore there you might have a conflict there, and you need to look at it in case that you are within the EU. And finally, the last point from my side is that if the absence of any tax treaties is effectively is it customary international law accepted by the countries? And here, in order effectively to answer these questions, we need to look at two principles, which is the principle of sovereignty and equality of states, which is the principle of territoriality, and the principle of non-interference. If you follow these two principles within customary international law, then you might find whether you breach these principles or not. And in order to do that, in order for the UTPR to be considered customary international law, you need to effectively fulfill these two conditions, whether this is state practice and whether this is opinion juris. If you fill these requirements, then effectively the UTPR will be part of your customary international law. So let's see whether you fulfill these requirements. An ideal example, as I said earlier, is CFC legislation. CFC legislation, it can be argued that is extraterritorial. And when it was first introduced by the US in 1962, it was considered that it might be violation of customary international law and effectively maybe not part of our international tax practice. However, we have seen CFC rules, they have flourished until today. From recent studies, more than 64 countries, they have CFC rules, and this has been done a lot after the BEPS project. So if we consider that the UTPR is kind of a reverse CFC or a similar CFC rule, then someone can argue that the UTPR is kind of a CFC protection. However, there are two arguments that the UTPR differs from CFC rule, and the one is that the parent controls the CFC, whereas in the affiliate entity, the UTPR country, the affiliate there does not control the parent, and also the CFC rules reflect the economic ownership of the CFC parent. And Ruby Aviona, our professor here, effectively argues in this article here that these two arguments fail. And the first argument that the control fails because there is a case law within the US, the Moore case, that effectively says that the requirement of control is not required when the US is applying its GILTI and Subpart F rules. Now, in order to see whether today, as we stand, whether we meet these two requirements, is it state practice? Is it opinion juris? And the answer might be yes, because we all know that the inclusive framework is in 140 countries that they approved the UTPR. Of course, the counter argument will be that this is soft law. And until today, there is a massive number of countries that they are applying UTPR. So arguably, someone can say that today, as we stand, with the majority of the countries, the increasing number of countries that they are applying UTPR and the IIR rules, maybe this is also considered part of our customary international law. And finally, I have another two examples, but I don't have the time to discuss them. This is another two examples that if you sell a package of shares under this level, under this level here, based on the domestic law of many states, the source state here, state D, might have a taxing right to tax the gain of the movable property, and this is allowed by the OECD and the UN model of Article 13.4, and the same applies if you sell a package of shares at this level here. We see this only on the UN model. If typically this is for substantial shareholdings, it gives a taxing right to the source state to tax this gain. Now, this is where I finish. Thank you very much. Happy to take any questions at the end. And of course, Demi and Ajay, feel free to pop in and discuss these topics. It's very interesting. And I'm handing over to my colleague Demis to discuss about the UTPR, if it is discriminatory or not under tax treaties.
Thank you, Christo. Thank you, Professor Christiana, as well, and everybody. Very nice to be here as well. I will cover a very interesting topic, which is discrimination. It's going to be a very short presentation from my side, but I really was spending a lot of time recently about this issue, and I think it's a big issue that has to be looked. So discrimination, I think, is both an easy and difficult subject. Easy because all of us, we can understand what it means. It means that discrimination is not allowed, of course. Difficult because always discrimination, in order to prove discrimination, you have to make a comparison. So a comparison of two people. You discriminate this person against the other person. And sometimes the comparison, as we'll see very shortly, is difficult to understand if you are comparing the correct comparables, apples with apples. This is the most complicated part of the discrimination. The issue of discrimination is started always from constitutions, EU law, and of course treaty law. And in the OECD treaty is Article 24. So in my next slide, if we step back a bit and think, what are the types of discrimination, especially in income taxes, but also more generally. So what I mean is that where you can discriminate, I think we have only two options. Number one option is the personal characteristic. So you discriminate someone because of his or her personal characteristics. That might mean a discrimination based on the identity, on the nationality, on the residency, on the relationship of members of the family, and etc. So we are looking at a discrimination about the personal characteristics of someone. Number two, the number two is a discrimination, which is a discrimination about the product, the production, the activity, the income. So you might say, this activity, I discriminate, period. So when we have these two broad principles or categorizations, then the next step is to dive into the Article 24 of the treaty and ask ourselves, what does treaty Article 24 stop discrimination? So in which area does the treaty prohibits discrimination? Is it on everything or is it just on some specific cases? When we read in an ordinary meaning the Article 24, we can understand that it prohibits discrimination mainly in three things: discrimination based on the nationality, personal characteristics, discrimination based on the activity, which is Article 24.3, and discrimination based on the ownership. So who is the owner, and you discriminate based on that. With that, and that's the latter will be the area that we'll use an example to show whether there are any issues of discrimination between Pillar 2 on the one hand, and on the other hand, pure domestic scenarios. So, next slide. On the left-hand side, we see that there is a group which falls under the Pillar 2 rules, more than 750 million of revenue. And then we see that this group is in state A, in state B, in state C. And of course, it falls under the Pillar 2 rules. The question that we have to show is whether this group here, right, if you fall under the Pillar 2, it will be, and this is the test, it will be discriminated, meaning in income tax, very simple, pay more taxes, right? And more taxes, it can mean a lot of things. It can mean higher rate, or it can mean I don't allow you some deductions, or a progressive rates, and etc. So a discrimination, it might mean simple if this group, again, with a comparability, as I said, discrimination is always a comparability. You cannot discriminate by looking only at one person. So in a comparison with this group here, which is exactly the same, more than 750 million, and it's only in one country, and for a reason, and I'm leaving out the EU law, because EU law captured this group as well under Pillar 2. In outside of EU, that group is not a multinational entity by the definition of the Pillar 2, therefore it doesn't fall under Pillar 2. So the question is, we have on the left-hand side a group that is doing exactly the same thing, exactly the same revenue, the same activity, and then we have another group that is just here. And then if we say that this company here, it will be paying higher taxes. The question, that's why I said discrimination is easy to understand and sometimes difficult to prove it. The Article 24.5 is telling us that the comparable, the group that we will compare, reading the wording is not very clear. Is the comparison the one I show here? So another group that is just domestic, is the comparison here the correct comparison? Is this the correct? Or is the comparison another group, for example, that is also here in this country, and in this country? And here, for a reason, there is implemented the IIR and everything for Pillar 2, and here it doesn't implement the IIR, and here it doesn't implement. So what I'm trying to say is that these issues are very, very important, because if we have an argument that whatever the comparison is, under some circumstances, a company, it will suffer higher taxes because of the under-tax payment rule. Therefore, we can understand that it looks that it falls under the non-discrimination article of 24.5. What do we do if it falls there? We're not allowed to discriminate. So that's a big issue. Something that my colleague Christos said, Article 24.4 is 24 in general applies to all the taxes. So we don't have to worry whether this Pillar 2 is an income tax, is not an income tax. That's a very important point. So what we have to look here is about the comparison. What we compare with what. And if we find that there is an issue of non-discrimination, then we are entering these uncharted waters, which for me, it's a very big issue to consider when we have Pillar 2 cases. So that's what I wanted to cover, the issue of non-discrimination, which we believe that is a very hot topic that needs to be looked very, very precisely. I just show one example here with one subsidiary, but the same can happen if this subsidiary here is not subsidiary, but it's also a permanent establishment, because we know here that in Pillar 2, this is also captured. Ps are elevated. They are treated like more as a company, as a resident company. And of course, when you compare a P on that state with a P of other, we can see as well in different taxation. Last point from me is that, as Christos mentioned, the way countries implement in their domestic law their treaties, it can be the monist or the dualist, this can play a role, because if you underwrite the treaty, that means all these issues that we're discussing of non-discrimination, it cannot be relevant, because underwriting, and in some countries they do that, underwriting meaning don't implement fully the treaties, that can be an issue as well. That's the last point that I wanted to cover. So conclusion, non-discrimination, the way I see it, the way I read it, the way I interpret it, I see that there is an issue here that has to be looked. So
Thank you.
From me, Christiana.
Thank you very much, Demis. Very interesting. Both of the presentations are very interesting. I just wanted to add that we do have a reference to the Court of Justice right now as to whether UTPR is in breach of the fundamental freedoms. It's in French. It's from a Belgian court. It's in French. If I'm not mistaken, Professor Kuzniewski has written some posts on LinkedIn on this, and actually put a translation, layman's translation, not an official one. So this is an issue that is also being picked up at EU level. And also, what is interesting is at EU level, domestic groups, the Pillar 2 rules and the UTPR by extension do not just apply for multinational cross-border groups, but also domestic groups. So this is sort of in a way going head on with the EU, and there are legitimate arguments as to whether there is incompatibility with tax treaties, whether this is a kind of CFC or something very different. So so in a way that the US response to this is not completely unjustified. One could say that there are grounds for this. For the hostility against the Pillar 2 rules, whether that's based on sort of theory or political reasons. And that's why I think it's very interesting to hear Professor Kuzniewski's and Ruben's view on this, and how, which is based on their paper. And, if you'd like to share some of their views on recent developments and the kind of side-by-side agreement that is what they're trying to achieve. Let me just share screen. Are you happy to start? I'll just share my screen.
Yes, thank you so much for invitation, for introduction, and to face the challenge of pronouncing my name and surname, which is an achievement. So.
Yes, I did a little practice. Mine is not any better, but anyway. Okay, let me just see.
Yeah, we can start with the title slide, and if I can change by myself, of course, I will do it. No, I can't. So I will just kindly ask you for helping me. I have few slides, so no problem with that. I also very like the previous presentations, and I have many comments and questions, but I will try to incorporate part of them in my presentation by connecting the dots between different sources of law. Of course, we are all more comfortable with tax law, but as you see from the title, here is the aspect of international law sensu largo, which is the international law of countermeasures. For about 5 years, I am fascinated with the interactions between tax law of various genres, being domestic, EU, international, with different elements of international law, starting with the specialized regime of international investment law, but also recently international public law sensu largo and the international law of countermeasures. So that's the idea. And maybe I will give you a little background about the cooperation with Professor Reuven Avi-Yonach. Those of you that knows my views on DSTs and Pillar 2 and Reuven, you would find this cooperation as surprising, if not shocking, because we have diverging views. And I will come back to it soon why and in which regard. But Reuven sent me email that he liked my article about the international law of countermeasures in respect of the US tax defense measures. This article from early May 2025, it was quite general, high-level article, because also the audience of Tax Notes International is not that familiar with international law. So of course I wanted to produce an intelligible piece. But from that email, we started to discuss, and we found out that the differences in our views may contribute to an interesting piece. And we thought that there's a need to dive deeply into the matter in question, especially in the face of Section 899 and very rapid developments on the side of retaliatory tariffs. Although Sections 899 and discussed in this presentation closely, 891 are different than retaliatory tariffs, from the perspective of trade and tax law, they belong to the same kingdom under international law of countermeasures. Namely, they are countermeasures. They are not per se, or they are not predominantly aiming to raise revenue in a given country that enact them, let's say US, but their predominant goal is to counteract, to coerce the states to stop doing something, and I will come back to it. So that's the background of our cooperation, and it's still work in progress. So if you have any comments, especially critical comments, we are very much welcome them and incorporate in our work. If we can look at this next slide, you will see that our article has been selected by the SSRN board for the roundup and the review, was provided by Professor Narodsky, Daron Narodsky. I recommend you to read that review. It's very robust, detailed review of our piece. Professor Narodsky is famous with having a sharp language, so if he is critical, then he's really critical all in, which is very good. We are also happy to announce that despite the article is only 2 weeks out on SSRN, already 250,000 of people download it, and we expect that more people will be interested to read it. As you see the title, the main title is The Rule of Law versus the Rule of Power. So we locate the discussion about DSTs and UTPR on the one side and the US reaction to them on the other side within one of the broadest possible, conceptually and methodologically speaking, clash that we observe nowadays, the rule of law on the one side and the rule of power on the other side. We think it's very important because if you look back to the origin of DSTs and Pillar 1 and the origin of UTPR and Pillar 2 and BEPS to 0, and you will track all news, you will track the debate that touched the surface and that is discussed at the level of the media is predominantly political discussion. You have the question of multinationals avoiding taxation or not paying fair share. You have the discussion around brick and mortar economy and the international tax rules and tax treaties, which are no longer coming up with the development with the digitalization, globalization and digitalization, or if you like, globalization of economy by digitalization, and the lack or no need for much, if at all, physical presence to generate astronomical amounts of money, income, to which national income systems apply. It was, and it still is, predominantly political debate. Almost all legal arguments were posed and delivered by scholars, and even in that sphere, And as we already know, there is no really unilateral approach. There are scholars that will defend UTPR and will criticize UTPR. They will say that this is discriminatory, and they will say it's not discriminatory. They will say that it's extraterritorial and it's non-extraterritorial. For the politician, it doesn't matter. Message is simplified. No one really dig deeply into technical analysis. So at the end of the day, if the rule of law and technical analysis is not prevalent or is not respected to a sufficient degree at the forum consisting of nearly 150 countries in the world, what you can expect? You may expect that the rule of power will be driving force, and the big power is used to big pressure, and then big pressure is pushing weak countries and weak players aside in the discussion. Their voice is silenced or at least reduced, and the predominant voice is the voice of those that carry the power. And we see the swings in the previous administration in US that was supportive towards Pillar 2, and we see the new swing now in the current administration in US that is not very happy with Pillar 2. It's about the power. There is not much legal argumentation behind this the clash. So if we look at the next slide, you will see that we selected Section 891 for the further discussion as a countermeasure because Section 899 has been dropped by the Synod in US as a result of the message from G7. So the message is that the OECD at the Forum of Inclusive Framework will discuss in order to propose a solution according to which Pillar 2 will function side by side with US system of minimum taxation. Side by side means that there is no need to recognize anything with each other. We will speak about that more with Christos, I believe, but there is absolutely no need to treat US GILTI as qualified IRR in order to avoid a clash. It's only need to let US continue to be outside the scope of the negative impact of Pillar 2. By negative impact, I mean economic impact, right? So as long as US companies will not suffer financially from Pillar 2 in a negative way, then there is side-by-side solution. How they will do it, whether there will be recognition of GILTI, GILTI pushed down, permanent safe harbor for UTPR, US doesn't really care much about it. What is important here is the pragmatic and effective approach. Whether the new solution will be more compatible with tax treaties, trade treaties, investment treaties, international law, again, no one really raised that question. And therefore, we with Ruven decided to raise that question and to show that the rule of law is also powerful, is not only rule of power. And very coincidentally, when we started to work over that article in May 2025, we didn't expect that the Court of Justice will be asked by the Constitutional Court in Belgium about the compatibility between UTPR and the EU directive. What's more, many experts from Belgium, which are much closer to Constitutional Court in Brussels, I believe than me or any of us, speculated that it's unlikely that the case will be upheld, that it's more likely that the Belgian court dismisses the case by saying that the non-profit US organizations do not have standing because they are not even taxpayers subject to UTPR, therefore they cannot suffer negative consequences, therefore this is all nonsensical claim. It was incorrect speculation. I was on the side who anticipated that the questions will indeed be asked, coincidentally, the Belgian court is famous with asking questions to Court of Justice, which regard the compatibility of the EU secondary law, like DAC 6 with EU primary law, and to which the Court of Justice answered in affirmative that directive is partly incompatible. So if that pattern will continue, we will have most likely very interesting legal analysis. Okay, but let's look closely at Section 891. It's very old law. This law has nearly 100 years. If I may speak a bit about the origin, so you may blame France for this law. Why? Because France didn't want to ratify the tax treaty with US in 1932. And at the same time, France had a special law that applied formula apportionment and that allows France to tax the US unrealized profits. And US found that taxation as extraterritorial. US said to France, you cannot treat our subsidiary as a branch because it's not a branch, it's a separate legal entity. France counter-argued, economically, it doesn't matter whether it's branch or subsidiary, it belongs to the parent can control it, parent owns it, etc. So US came up in this time with the arm's length approach, allowing to recognize that separate legal entities are also separate taxpayers, and you cannot really freely allocate income between them. You need to follow arm's length principle. And also US said to France, unless the US subsidiary will distribute dividends to France or distribute profits in other ways, like capital gains, you have no right to tax it. France ignored it, probably to raise the revenue after the Great Recession in 1930s, after 1929 Black Friday, and after First Great War, etc., etc. So if France ratified the treaty with US, then France will effectively lose the right to apply this extraterritorial law. But France didn't want to do that. So we can read from the historical notes of Michel B. Carroll, who was back in the then responsible, among the others, in charge of tax treaty negotiation, that the US decided to implement Section 891 to coerce France to ratify treaty with United States. And it worked. After implementation, the France ratified the treaty with US in 1934 or 35. And what this law says, this law allows the US president to decide, and this is a great discretionary power, by the way, decides to double the income tax on the foreign nationals, citizens and corporations, so not even tax residents, but I will come back to it, on foreign citizens and corporations in respect of the income effectively connected with the US. So for example, every foreign disregarded entity in US will be subject to double rates from 35 to 70%, for example. Every foreign citizen from the employment or business in US will be subject to double rate instead of 37 to astonishing 74% of taxation. Whereas foreign subsidiaries in US will be subject to that tax only upon the distribution of profits in the form of dividend, royalties, or interest. Capital gains will be subject to portfolio exemption, and eventually Section 899 will be most effective towards foreign businesses that cannot switch from subsidiary from branch to subsidiary, for example, to foreign banks, because the U.S. regulatory law requires that they need to have subsidiary and their active businesses effectively connected with the U.S. territory, and therefore will be subject to double rates. This law is at the same time not very suitable to coerce any state to do anything, because it's easy to circumvent. You can make redemptions instead of dividend payments. You can just wait and do not distribute dividends until something changes, and Section 899 will not be applied because the government changes in US. You can even go as far as liquidate company, and the proceeds from liquidation will be subject to portfolio exemption. But it's very problematic for individuals and banks. Imagine that even if you are dual citizen, you are US citizen and French citizen at the same time, this law will still lead to the double taxation. This law may also apply retroactively. So if the US president decides to activate that section on December 31st this year, because the G7 deal will not be implemented, it will apply from 1st Jan 2025. But there are many problems with this law. In addition to the effectiveness, is a problem with tax treaties, because I will come back to it. US law, US Constitution allows for treaty override, but only lex posterior. So every treaty that was ratified by US after 1935 may override Section 891, and Section 891 is blatantly discriminatory. You see, it applies, it allows to double tax rate only to foreign citizens and corporations, not to US corporations. So it's discriminatory under US treaties. But there are also many places that US don't have treaties with them, like in Africa, South America, and Asia. So that argument will not apply. But this is just the broad description of Section 891. If we go to the next slide, I will share with you why it is important, not only academically, but also legally, and legally from the perspective of the US constitutional law. So yeah, it's fine, it's perfect. So Article 6, Clause 2 of the US Constitution contains the so-called supremacy clause, which basically put US domestic law and international treaties and also implicitly customary international law on equal footing, which means, as per the Supreme Court jurisprudence and also the position of the American Law Institute and the restatements of the law that they announce from time to time, that later in time, domestic law will prevail over international law, various sources, be it tax treaties, trade treaties, investment treaties, multilateral treaties, bilateral treaties, and customary international law. But more modern US case law put a question mark whether this later in time override applies to only to explicit override, explicit, clear, or plain override, or only or also to implicit one. It was a problem with Section 899, I'm sorry, and it will be a problem with Section 899 because the explicit treaty override language has been dropped in order to avoid the legislative conundrum at the level of the US Senate and US Congress. As a result, one may question that if Section 899 will be enacted, then the overreading power of Section 899 may be questioned by the U.S. domestic courts. It's put to it's ambiguous. But for Section 891, there is no ambiguous sphere here. It's much older than treaties, so treaties shall override. And now, from the perspective of customary international law, it's important to recognize three elements. First, you can find customary international law, the SIL in abbreviation, on countermeasures, in codified document by the International Law Commission called ARCIVA, Articles on the Responsibility of States for Internationally Wrongful Acts. It was published in 2001. And a year after, in the WTO, World Trade Organization trade dispute between US and its counterpart, US explicitly recognized the principle of proportionality as a core element of customary international law on countermeasures, which means that every US countermeasure, be it trade countermeasure like tariff or tax countermeasure like Section 891, but also Section 899 and Section 896, that I will not discuss much, but you can see it in our article, is subject to later in time overreading qualification approach. So because Section 891 was enacted way before US recognized customary international law on countermeasures and principle of proportionality, 2002 versus 1934, the seal on countermeasures shall override Section 891. For Section 899, it will be the question of explicit versus implicit override. So now we have 2025, and the overarching legal question that may be posed before the US courts is, can Section 891 override seal on countermeasures, although the latter is later in law ruled? And of course, it is important to the extent to which Section 891 violates seal on countermeasures, because if not, they will peacefully coexist. So we can go to the next slide, and then we will look a bit closer what is the interactions between the US tax countermeasures, Section 891, and international law. So from the perspective of customary international law on countermeasures, you need to first ask the question whether there is anything to which you can respond, and that anything means internationally wrongful act under Article 2 of the RCEVA rules. So the starting point in our discussion is to determine whether the UTPR and the DSTs, which are target of Section 891 and possibly Section 891, if that section would be reenacted, if they violate international law. Because internationally wrongful act is an act of a state which leads to violation of any source of international law, be it violation of tax treaty, investment treaty, trade treaty, customary international law. If the answer is positive, we can move to the next step. If the answer is negative, and yet US will apply countermeasures against such measure like UTPR or DST, then such rule cannot be seen as compatible with international law. But let's assume for the discussion purposes, despite the diverging views in scholarship, that DSTs and UTPR may violate international law, which is in itself an unsolved question, because we have diverging views of scholars. No one is super persuasive, I would say, and we have zero jurisprudence, which is more authoritative than views of scholars in that regard, and especially for states. We may have the first decision by the Court of Justice of the European Union. I don't recognize any domestic challenge so far or investment arbitration. So let's say that UTPR and DSTs violate international law, and therefore US has a way to implement or to activate existing countermeasures like Section 891. Then such response of the US must comply with relevant rules of RCEVA, customary international law. I will share with you just two overarching articles. Article 49, paragraph 1, which sets the object and limits for the countermeasures. It says, I quote, an injured state, in that case, US being injured by the UTPR and DST, may only take countermeasures against a state which is responsible for an internationally wrongful act. So let's say for violation of US tax treaties by means of taxation of the US companies under DSTs or UTPR, which has never taken place yet under UTPR at least, in order to induce that state to comply with its obligation under Part 2. And I here highlighted in red that it doesn't mean that US can target a state, but cannot target a corporation or citizen of that state. It may. It is not clear-cut, but the prevailing scholarship and international jurisprudence says that, of course, it's possible for a state to indirectly target a foreign state by, let's say, imposing certain sanctions or trade limitations or increasing taxation on the citizens or corporations. So far, so good. US is targeting only states with UTPR and DSTs under the assumption that they violate international law, which is by itself subject to challenge, as I said. But then we go to the next step, and it leads us to the nub of the discussion. The question is whether the US approach is proportional. Why? Because as Professor James Crawford, the former judge of the ICJ and the author as a special reporter of the UN Nation, author of RCEVA rules, said the countermeasures must function as a form of inducement, not a punishment. If a countermeasure is disproportional, it suits more to punish foreign state rather than coerce foreign state to comply with international law. So let's look last slide, how principle of proportionality shall operate in respect to examine whether the US tax countermeasures are compatible with international law. If you can, yeah. So that's so we have first the well-known, I think, from the Court of Justice case law for many of you, tripartite, three-element approach to proportionality. First, we need to see whether a measure is suitable to its goal. It's the easiest out of three tests for proportionality. Typically, a measure is suitable, while any state would like to have a measure that is not suitable. But in our work with Reuven, we challenge that Section 891 is fully suitable because it's easy to circumvent in the ways I mentioned. It will capture mainly foreign banks with present in the US and natural persons in many instances. But to the extent to which it is suitable to target properly foreign citizens and corporations, it is extremely drastic. So then we switch to the second element of proportionality test, which is necessity. The question is whether the Section 891 is necessary to achieve a goal and does not go beyond that what is necessary. And here you may question that whether it doesn't go beyond, because it double rates and it doesn't really reflect the effective taxation under DSTs or UTPR of the US multinational companies, but I will come back to it. The third element and final is the so-called proportionality stricto sensu, in narrow sense, which is a weighting, a balancing exercise in which international courts and tribunals, also Court of Justice, looks what public element of functioning of state is protected. Is it protected something very important or less important? It is protected something that is shared by international community as to be protected, for example, recognition and prevention of international crime by means of tax evasion, or maybe it is rather a local economic self-interest of the state which is protected. And what right and freedom is restricted on the other side. So there is this balance. If you envision an example, you may think about example in which Section 891 is, if activated, will lead to the total expropriation. Business will become completely unviable economically in the US if subject to 70 or 74% of taxation. So it's quite difficult to find a justification on the side of the US to apply such drastic rule. And now, if we look at the content of Article 51, which is the principle of proportionality, it says countermeasures must be commensurate with the injury suffered, taking into account the gravity of the internationally wrongful act and the rights in question, which means that if DSTs and UTPR lead to a certain effective taxation, let's say for a selected company up to 10 million or $1 billion, let's say, then you cannot impose 1,000 billion, which is 1 trillion, because it will not be commensurate to the injury suffered in economic sense. For the families that will be subject to double taxation in US, it may mean a complete catastrophe. Their businesses may not be economically feasible at all. They would need to leave US, and it will be it may have far-reaching implications of the international human rights. To make a point to Christos' presentation about treaty overreading that is possible in US and in Germany, there is quite recent decision of the German Constitutional Court in which German court stated, yes, our constitution permits for treaty overreading, but not perhaps treaties that protect international human rights. It will go too far. Of course, when you think about taxation, you don't think about violation of international human rights. However, there have been cases in which tax measures were used to quash international human rights, like, to give you an example, Yukos versus Russia case. So the way how principle of proportionality operates in the law of countermeasures, not military countermeasures like trade and tax countermeasures, is a reasonable equivalence between provocation, wrongdoing, which is UTPR and DST taxation, and respond, which is Section 891. You look for a reasonable equivalence, which means that it does not need to be a mathematical, precise, identical taxation on the side of the US and on the side, let's say, of France with DST, but at least it must be a reasonable equivalence. it means that the US can charge higher effective taxation on the French corporations that the France does so under French DST, but the difference must not be unreasonable. So we may, of course, now open the discussion, but this is more or less the gist of the part of our article, which is still in progress. And I am really grateful for Christiana to give me a chance to speak a bit about it.
Thank you. It's actually very interesting that you raised these arguments. I will open the floor for questions. I don't know if Christos or Demis have something to, the other speakers have something to add.
Yeah, maybe I can add.
Question. Yeah.
Maybe I can add a comment, and Blaže mentioned it very well. Despite if you are a dual state, doesn't mean automatically you override the treaty, the domestic law. So there are some requirements. And one of them, apart from the one that Blaže also mentioned, typically you need to look at what is the purpose of the treaty, and you need to look at why you want the domestic law to override the treaty. And the counter argument will be, but why would the treaty will override the domestic law? Because this is not in the spirit of the treaty. So the spirit of the treaty is typically for tax avoidance and evasion. So maybe the UTPR might not be considered part of the spirit of the treaty. So there might be a counter argument there that why the domestic law will override the treaty, because this was not part of the treaty when the treaty was concluded, for example. So there are counter arguments of overriding the treaty or not, and you need to effectively see the domestic law of the country, how the treaty is overridden, and how this might be applied in practice, of course.
I don't think we have any questions on the chat. There was a question on compatibility with EU law, but I think I already mentioned it, and I think Professor Kuchniatsky has also mentioned it. It is a reference, we're still waiting, but it is quite interesting the way to decide how we decide. I think it's quite interesting. Do we have any other questions? I have a question. I don't know if it's to all the speakers, I guess, not just Blaže. How do you actually see this? The issues with the US. How do you see them developing on a more practical level? Do you believe that the side-by-side agreement will basically whitewash the US multinationals, which would create a satisfaction with everybody else? There's already been a couple of voices in the EU saying, "Oh, we need to, we need to withdraw Pillar 2 directive." Or do you think the GILTI, US GILTI, or generally the US tax regime can be slightly changed so that it fits with the Pillar 2 regime? So this is a question for any of the speakers. Christos wants to answer this, or Blaže, just out of curiosity, how do you, I know you don't have a crystal ball, but how do you see this going forward?
It's open discussion, guys. Presumably, the new agreement between the G7 and the US, of course, is not binding with the OECD inclusive framework. There is work to be done and find the details. But I will say that after the agreement, it seems that they agreed that Pillar 2 will remain, but on a side-by-side basis. So presumably, maybe the question right now whether Pillar 2 will exist, it's kind of maybe fading out. But what they agreed is effectively the US will say, you want to implement the global 15%, presumably let's do this, and I will not implement it, but I will ensure that everybody else will implement it other than myself. How this will be done, not sure. We need to see the details. But presumably now is one step more to having a global tax rate rather than before.
It is viable. That we have one question. So I also agree. I think this shows that through the political compromise, Pillar 2 will likely become viable once you get the US on board one way or another. There's a question for Professor Kuzniewski. Do you believe that if Code Section 899 were enforced, it could potentially be challenged under any of the substantive standards set out in international investment agreements?
Yeah, okay. So, I mean, in general, it may be a challenge legally under different sources of law, including investment treaties, but so far no one really dared to do it. And even a bloc of states like EU never used the arguments under international law, although Article 2 of the Treaty on the European Union says that the EU is based, one of the foundational pillars of the EU is the rule of law. So it's quite interesting how EU may switch from the rule of law to politics for the purposes of having conciliatory relations with the US. But the quick answer is it depends. If an investor in US will be subject to so high taxation that it will be expropriated in US, then the answer is yes, because US investment treaties carve out taxation measures to a large extent, except expropriation. Another question would be, is Section 899 a tax measure, or it's not a tax measure, but because it's countermeasure? If it's countermeasure, that it may all investment standards will protect foreign investors in US. But if it's tax measure, only expropriation and the so-called umbrella clause. And the last point is that US has never lost any investment treaty arbitration, is a big winner. So if that would happen, it's very difficult to challenge US in front of investment treaty arbitration and to prevail.
Sorry, Professor, just a comment from me. I don't know. Sorry, Professor Blažević, did you finish your point?
Yeah, of course.
All right. Thank you. Do you have time, Professor Christiana? Just a quick comment.
Yes, of course. Yes.
All right. 2 points from me about this idea of side by side. I think the first thing is that what is all this about? And the Pillar 2 and the GILTI are minimum taxes. What does it mean, minimum taxes? If a country wanted to secure its source taxation or its residence taxation, it could do it by denying the payments from any country other, right? But the minimum taxes is doing beyond that. It's just telling us that if in a group structure there is a company that is low tax, irrespective if that company has transactions with end clients or with other related companies, that company in that country, which is a low tax country, you need to add a minimum taxes, period. So that's my prediction. I believe that it's very hard to go back to a picture of the world where there are no minimum taxes. Because the whole idea after the BEPS 1, what was missing from there, it was all about the rate and especially the effective tax rate. So I believe that minimum taxes, which we have seen in Pillar 2 in EU and of course in the US, I think that's the new reality, and I think it's very hard to imagine a world without them. Number 2, the idea of side by side. I'm not sure what it means, because side by side, I can understand when they don't interlink or when they don't cross over. But when in a group you have, for example, an intermediary, which is a US or is a European in the middle, they call it POP, which is partially owned parent entity. How that this whole system will react? We need to see the rules. So I believe that side by side is easy to say, but the details are very, very important to see how you can end up reconcile all these rules. I think that's difficult for me.
Oh, okay, just to say, We did have a question about the side-by-side, whether it would disadvantage other countries implementing Pillar 2. So I agree with you. Until we have the details, it's very difficult to tell how this will happen. And we also have another question, again, if with the side-by-side or being carved out, if how we will work under EU law or domestic law. This is an interesting question, actually. We don't have the details, so we can't really predict or even give our views on this. But certainly, if the US is exempt, that or if it's very clearly favored, that will raise a host of issues. Not just the legitimacy of it, the very vague sort of fairness perspective, but also potentially other issues. I don't know, maybe the foreign subsidies rule in the EU, or I don't know, state aid, if there is if it affects internal trade. I don't know if you would like to add something to this, Blagier. And there's another question on if the US is justified to push for exemption because it has similar rules. So I guess this is quite kind of similar. Is the US already somewhere near there? So if not, and they're getting a side-by-side agreement, which is very much in their favor, where does this leave the whole project in terms of fairness and dealing with the problems of with digital businesses? So I mean, this is a question, I guess, for all.
If I may briefly, I think all these three questions refer to more or less same, whether the fact that US has the unique taxation regime consisting of GILTI, corporate alternative minimum taxation, FDII, etc., as modified by one big beautiful bill act, OBBA, means that we can recognize them as meeting the global minimum taxation approach just by own way, and not the way put forward by the OECD. And that's the bedrock for the G7 decision. So G7 was convinced that the answer is affirmative, and now the solution should be worked out by inclusive framework. But this opens or may open a Pandora box, because countries like China and India may also like to find concession. So here the opposition of the OECD will be, well, but you don't have rules similar to US. And they will say, yes, because we are different countries and sovereignty allows us to have different approach. Give us 12 months time with a kind of permanent safe harbors in respect of X, Y, Z to protect our MNEs as you decided to protect US. Of course, we are different countries, we have different pasts, and therefore we have right to have a different treatment as well. If that happens at the Forum of Inclusive Framework, then we may have many different concessions for different countries or even blocks like BRICS, like African Tax Forum, etc. We may have a question whether qualifiable versus refundable versus non-refundable tax credits make sense, because they are very difficult to comply with by low-income states. They are not cash-rich states, and when you need to refund, you need to have cash. There may be a question of collateral benefit concept, which is legally very vague and restricts the freedom to decide about economic and investment policy, not even tax policy. Many questions may resurface. Side-by-sides, I think, means colloquially that Pillar 2 shall not interact with taxation of any US company in the US multinational group, which is in scope of any US rule belong to the regime of minimum taxation, be it GILTI or CAMT or any other rule. That's what side-by-side, I think, means. That despite the differences between GILTI and IRR, which is jurisdictional blending and the global blending.
Thank you. I don't think we have any more questions. Just to I put a comment to everybody who are interested. We have an executive education course online on Pillar 2 starting in October. I've put the details on the in the chat. Would you advise? We have a question by Camilla. Would you advise MNE groups to continue preparing for Pillar 2 compliance in that 9? Or would you suggest suspending them? I would definitely not suggest suspending these efforts. I think Pillar 2 is here to stay, at least for the foreseeable future. And a lot of countries are basing sort of their revenues, what they're estimating to come in, and also on Pillar 2 rules, sort of the IIR. So definitely in the European Union, I don't think they're moving away from this. We're a long way from that. If there is a big decision of the Court of Justice which really taints the whole of the directive, we might see amendments. But until then, I don't think Pillar 2 is going anywhere, to be honest. I think it's here to stay, basically. And it's good to have research by people like Lager and Ruben Aviona trying to basically align the rule of law with with Pillar 2 and try and find solutions in a way that are within the realm of the rule of law rather than the rule of power. I don't know if anybody, any of the speakers have any last comments. We only have a few minutes left, and we are sort of long with the end when we should end this. But it was a very interesting discussion. We did expect questions and a lot of interest. Do you have any comments, Blaže? Do you have any last comments?
On my side, I'm very happy. So pass.
Yeah. Christos, Demis, do you have anything to add? Anything?
Thanks for the invitation from my side. Pleasure to be here. Thanks, Christiana, and thanks for being so attentive, guys. Pleasure.
Thank you, Professor. Thank you for having me.
Okay, we do have a final question, but he's a PhD student of mine, so I might be showing a little bit of favoritism allowing the question. It's actually a comment. It says, if Pillar 1 and 2 fail, it will have consequences of how we perceive the success of the BEPS project. I'm not so sure about Pillar 1, if that's going forward, but I think Pillar 2 is one of the things that we got caught in it. It is what it is. And I think we just need to live with this reality and make the most of it within the scope of the rule of law. Thank you very much, everybody, for attending. Look at our events, sign up for our events, sign up for executive education courses, and thank you very much for your interest in our work. And thank you to the speakers, obviously.
Thank you. Bye.
Well,
Bye.
bye-bye.